plenty of energy experts out there who love to ruminate on the future direction of oil prices. But you know that there's only one guy who got it right, the lower for longer call, well before it became a reality. I'm talking about Braziel. He's one of the most respected authorities in the energy space, who's the president and principal energy markets consultant for RBN Energy, which I devour every morning. It serves as a best one-stop shop for energy data analysis and market commentary that there is. He's also the author of The Domino Effect, How the Shale Revolution and Transforming Energy Markets, Industries, and Economics. And I got to tell you, it's the #1 bestseller in the category. Given how important oil has become to the direction of the stock market, whether or not that makes any rational sense, I think it's crucial to get a reality check on the oil patch. Because according to Rusty, this could be another tough year for the industry. Don't take it from me. Let's check in with the man who totally nailed it. Totally nailed it all the way. The only guy that I deal with, Rusty Braziel. Welcome to Mad Money. Rusty, thank you so much for coming on.
Yeah.
All right, Rusty, I'm going to ask you point blank. Why did you know? I mean, every time I would email you in the morning, I'd say, well, this guy says it's bottom. This time it's going to bottom. He said, you don't know that, Jim. You don't know that. How did you know not to call a bottom at 60? I called you at 80, 70, 60, 50, 40, and now 30. And never once did you say there's a reason why I could stop here.
Absolutely right. Well, I mean, it's all oversupply, right? So the only thing that could fix oversupply is either demand. Well, we looked at demand, and demand just couldn't react fast enough to happen. So then it has to be supply. There was really only two supply things that could fix the market. Number one, it had to be either the U.S. production would have to fall because prices got so low, or it'd have to be the Saudis. So we looked at the U.S. side and looked at the economics. And at 50 and 40 and to some extent even 30, there are parts of these plays that can make money. There are parts of these plays where the economics of producing are still okay. It's the sweet spots, assuming that producers reduce their cost. So that's one thing.
But now, you also said it's not in the Saudis' interest to do what everybody thinks they want to do.
Absolutely. The Saudis are not going to save U.S. producers from themselves. Right. They're not going to do it because let's say the Saudis reduce their production.
Right.
So what's going to happen? Okay, prices go back up.
Right.
So what's going to happen? Then U.S. producers are going to jump in there, produce more, and if they do, then prices are going to go right back down. So now the Saudis have got less market share and less price. Why would they do that? It would just be nuts.
Well, this is a scenario where you could conceivably see oil $20.
Well, you know, right now the market is trading emotionally.
Right.
It's all about emotion. There is no natural floor in a short-term crude oil market. There's nothing that's going to stop it at $25 or $20. All that's going to happen is the market is going to react to whatever sort of stimuli comes in, like does China melt down, does Iran crank up production, or whatever it is, whatever happens to hit the market is going to affect market psychology. You talk about market psychology all the time in terms of stocks. It's the same thing with crude oil traders. They might be even a little more emotional.
Okay, and I know you've been around. You've worked at everybody with Chevron, Williams. Natural gas, any different from oil?
Yeah, natural gas is different from oil. Natural gas production has stayed up there, and even with prices as low as it is, natural gas demand is going to kick in over the next few years.
You had a great piece the other day that showed you year over year there's a genuine increase in the amount of natural gas in this country.
Absolutely, absolutely.
The use is up.
And use is up, and surprisingly so, as a matter of fact. But, you know, demand is good for producers. So that is going to be a good thing for producers. Demand's going to be up. My guess is natural gas prices are going to come up a little bit. But same thing we were talking about crude oil. When it does, what are U.S. producers going to do? They're going to jump in there with 2 feet, start producing more natural gas. Prices are going to come down again. So ultimately, this is good for consumers. Cheap energy has got to be good for consumers, right?
Look, you know the banks, you know all the players. Why were the financial markets so kind and allowing these guys to have the credit, even though you and I know that this is a very tough time for them?
Because remember what you said about all those other analysts saying that we were going to hit a bottom? There was going to be a W, or there was going to be a V, or there was going to be a U, or there was going to be something.
To stop using those terms.
Stop using those terms because it's not going to happen that way. Everybody else bought into that.
Right. Now, exporting. Turned out, I thought it might mean something. You told me, Jim,
Well, you know, if it had happened 2 years ago, that would have been great.
Okay.
We had way too much light sweet crude. We had way too much condensate. Prices were way down here because of that. And that was 2 years ago. Well, what did we do? We spent a lot of money on refinery modifications. We built splitters. Kinder Morgan built their splitter, et cetera. And the Department of Commerce allowed exports of condensates, processed condensates. So the problem pretty much went away. So now prices in the United States, prices in the rest of the world are pretty much the same, so it doesn't make a lot of sense to take it from here and take it to there if the price is the same, although there are still some special situations where it does make sense to export. Like, for example, if I'm in Corpus and my alternative is going on a Jones Act expensive vessel to somewhere else in the United States, yeah, I can probably go to Europe or I can go to Latin America and be better off.
All right, one last question. You're the pro. What happens next?
Well, you know, prices are going to be low. Production is going to come down. Because production is going to come down, there's a reasonable chance that prices could perk back up again, and I think they probably will.
70, like Boone said?
No chance in hell. Can I say? Oh, I can't say that.
It's all right, you said it.
Okay, fine. No, I do not believe that the $70 is going to happen. But, you know, I think where we are is we're trading in a range, and you know what that looks like from the stock market. Right. That's what we've got here. We're trading in a range. So what does it look like? I lived through this in 1986. I was a trader in 1986. Prices of crude oil dropped from $30 down to $10. Then they jumped back up from $10 to about 15, and then traded from 15 to 22 for the next 14 years. There's an exception, sure.
Right.
Desert Storm, prices jumped way up. But the rest of the time, prices were within that $7 range for the entire 14-year period. I'm not saying that that's going to happen this time around, but I'm saying we are in a range. Get that R word, recovery, out of your vocabulary. It's not going to happen.
Thank you very much. Now we're going to leave it on that. That's thank you to Rusty Braziel, RBN president. A great book, The Domino Effect. I read this guy every morning. He's kept me from calling a bottom. Thank you so much. Mad Money's back in. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.